Hello friends, today I am going to talk about one of the very premium categories of stocks in the stock markets, that is multinational corporation stocks, also popularly known as MNCs. Before dwelling more into MNCs, first let's understand what are MNCs and why are they considered different. MNCs are those companies which are operating in many different countries at the same time. In other words, a multinational corporation has operations and assets in at least one country other than its home country. There are three models in which MNCs operate: centralized, regional, and multinational or transnational model. In this centralized model, the company operates through one centralized headquarter in its home country, which helps it to avoid taxes. In the regional model, all the parent company's subsidiaries and its affiliate have to report to the MNC's headquarters located in one country. Lastly, the multinational or transnational model is like a combination of the above models. It gives the subsidiaries of MNCs located in different countries more independence to operate, and there is no need to regularly report to its parent company's headquarters. Most of the MNCs operate in this model only. Why should you choose MNC stocks over other stocks? MNCs are those companies in which the foreign shareholding is over 50% and the management control is vested in the foreign company. MNC stocks are known for their good image, strong parentage, strong technological proficiency, and their asset-light business models. These companies are usually well capitalized and have low debt exposures and good dividend policies. MNCs are present in key sectors of the Indian economy and have played an important role in development of the economy by bringing in latest technologies and know-how. Now, let's understand some of the key factors an investor should look at before adding MNC stocks to their portfolio. History of parent company. It is important to know the parent company before investing in its subsidiary registered as an MNC in other country. This will give you an idea as to how experienced the parent company is in managing its businesses. Usually, MNCs have decades of experience across the world and they have already seen many business cycles across all continents. For example, companies like HUL, Nestle and Bata have been in India since more than 60 years. These brands are literally so engraved in Indian minds that people don't even realize that these are foreign companies. Corporate governance standards. One of the major advantages for investing in MNCs is the top-notch management quality and high corporate governance standards. Generally, MNC stocks are picked on the basis of safety which they give to investors about their going concern status, as investors feel more confident about the management as compared to domestic companies. Also, MNCs tend to follow stringent internal policies and internal controls to keep all the quality controls in check, and by doing this, they stand out from their domestic peers. For example, old companies like Nestle, Bata have rarely encountered corporate governance issues in their management over the past years. Top and bottom line growth. While selecting MNCs, you should look at companies which are performing consistently. Apart from the company's history and corporate governance, you should look at the company's last 5 years sales and profit growth, which should be higher than its domestic peers. For example, Britannia's sales during the last 5 years have grown at a CAGR of 8.8% and its profits have grown at a CAGR of 19%, which is much higher than its Indian peer Marico, which has grown its sales and profits at a CAGR growth of 4.5% and 13% during the last 5 years. Return ratios. Many MNC stocks are well known to provide high returns. Before investing in any MNC, you should check popular return ratios like return on equity and return on capital employed. These ratios will give you an exact picture if the company's operational performance is being translated to its bottom line and how it is servicing its equity and debt. For example, all companies in our model portfolio have very high return ratios and as well as operating profit margins, which gives them an edge over its domestic peers. High dividend yields. MNCs are known for rewarding its shareholders with high dividends, and as the government in its last budget announced to abolish dividend distribution tax, MNCs are going to be the biggest beneficiary of this move. Some MNCs have already started paying high dividends from this quarter itself. For instance, Oracle and Nestle paid Rs 180 per share and Rs 61 per share as dividends, as against 0 per share and 25 per share in the previous year's same quarter. Oracle and Nestle has been maintaining a healthy dividend yield of 6.3 and 1.9% respectively. This indicates the MNCs will reward more in dividends to their shareholders due to the dividend distribution tax waiver. However, despite all the advantages, MNCs also carry some risks, which are as follows. Limited control. The multinational corporations are controlled by their parent companies, and due to high control over its subsidiaries, these MNC stocks can be controlled at the whim of their parent companies. The parent company can anytime decide to disinvest or stop funding to their subsidiaries. They can also transfer subsidiaries' major components such as research and development, plant and machinery, etc. elsewhere, which can be highly risky. Royalty concerns. Royalty refers to the amount which a parent company takes from its subsidiaries across countries. These charges could be high or low depending upon the capabilities of the company. The parent company may even try to siphon out profits from its subsidiaries through the high royalty charges or other fees that can be increased at the desire of the parent company. Hence, as subsidiaries, companies have to be more careful. Thank you. I hope this video helps you select the right MNC stocks for your portfolio.